Welcome to Business on the Vine. I'm your host, Lady Jen Du Plessis, and in this dynamic series, we dive into the challenges, breakthroughs, and victories of entrepreneurs who have turned their passion into success. Welcome. Hi, everybody. Welcome. We're so glad that you're here. Today with me is Jason Henderson, and I am so excited to talk about this subject. We've talked about this before on another of my podcasts called Success to Significance, Life After Breaking Through Glass Ceilings. And Jason and his beautiful wife were also guests on my TV show of the same name of Business on the Vine. So look for that to be coming out in the spring of 2025. But I wanted to get him on here today for a couple different reasons. One is as one of the founding guests, I guess that's what you call it, or inaugural guests of the TV show. I wanted to also have you on Business on the Vine as quickly as we possibly could, reminding everyone that we released Business on the Vine about a month and a half ago, and we encourage you to pay it forward, share with everybody, subscribe, follow us. We'd love to have you on the show, listening to the show. So the other reason I wanted to bring you on at this particular time of the year that we are recording this is to talk about, well, we're going to talk about 401ks, but I definitely want to be talking about 401ks today. Your specialty, however, Jason, is in infinite banking. And I know that a lot of people don't really know what that is. So we need to talk about that and how we can apply that to not only wealth creation, but what can we do in our businesses with infinite banking? So let's start there. Oh, and by the way, you are the author of Master Your Millions, book that came out earlier this year, right? Has it been?
Correct.
Okay, I don't even know about time frames anymore. It's crazy. But it came out earlier this year, and I had the wonderful privilege of being able to write an endorsement in that book and read the book. It's fantastic. So we'll have a link to the book provided to everybody. But let's talk about what is infinite banking and what are some other phrases people may have heard that would depict nearly the similar, it's a similar thing. I know there's some nuances there, but the basic thing about it.
So that all started with a man by the name of R. Nelson Nash. He wrote a book called Becoming Your Own Banker, and the subtitle to that is Unlocking the Infinite Banking Concept. So then people have shortened that to infinite banking, infinity banking, bank on yourself, family banking, lots of different things. And it all revolves around this central concept. Sometimes people even use, there's a section of the IRS code, section 7702. Sometimes they'll call them 770 plans, 7702 plans. Lots of crazy different, their marketing, twist on the whole concept.
Yeah. But there's one basic concept that this is, and let's talk about that.
And the concept is, and it's more important, it's really kind of a lifestyle, it's a mindset more than anything, and learning to take control of your financial environment. And part of that control is simply getting financial education to understand what's going on in the financial world. When you understand that and who the players of the play are, then you know what to do. Now, the best way, the absolute ultimate way to do that and to become your own banker is to use a whole life insurance policy from a mutual company that's designed for cash accumulation, not for death benefit. Now, you might have the best company, the best design from the best agent or whatever it is. It still comes back to, are you disciplined and do you behave in the right way? If you're not disciplined and you don't behave in the right way, the whole thing it's fluff.
Yeah.
Really.
And I think that's one of the reasons. Well, there's a couple of reasons why. I'll give a perspective here and then you can chirp in on what you think as well. But one of the reasons that a lot of financial advisors don't, when you approach them about whole life, they say, "Oh, you don't want that. That's not good. That's not good, right?" They let me give you a term policy, right? They prefer to give you a term policy, and it's cheaper, right? So one of the things that I learned being in the financial services business for so many years is that most financial advisors don't understand how whole life works and how to make it or maneuver within it to create wealth for people, right? They don't quite understand it. And so their natural tendency is to say, don't get it, because they don't understand it. So they're not going to have you get it. One. Number two is they don't get paid a lot on these whole life policies. And so they'd rather have you do broker accounts with them and, ETFs or whatever it is with them. But this is the thing that I love about you, is that this is what you do. This is specifically the niche that you're in, providing whole life insurance policies for the purpose of creating wealth for people. So is there anything else I missed that maybe would be a reason that a financial planner, if someone listening says, well, oh, this is a great idea, I'm going to run to my financial planner, and then they get shot down?
We are simply not understanding it. Also, traditional or typical whole life insurance is all about death benefit. And what we are after is cash value. And that's where the difference in commission comes in as well. Because typical whole life insurance doesn't grow very fast.
Yeah.
And, you know, I'm sorry, Lady Jen, you go into McDonald's and you order your quarter pounder and you don't get it in 3 minutes, you start to get hangry.
Right.
We all
Right.
do. We're consumerized that we got to have that instant gratification. And with typical whole life insurance, the buildup of cash takes several years. So
Yeah,
when
I know. I had a financial planner tell me, just be patient. Here's our 30 and 40-year plan. And I'm going, with 30 or 40 years, you got to be kidding me. Yeah.
yeah, I want to live now. I want to enjoy now. I want to go fishing or whatever it is right now. That's another thing that I would add to what you were saying.
Yeah. Okay. So can you break this down for someone who's listening? And I promise you, listen, I promise you, we are going to get to the point where you'll understand why you want this in your business. Well, why you want it in your life, and then why you want it in your business. I subscribe to all of what we're talking about. And I have vetted it for years. I love this concept, and it helps me in my business, and it helps me with my family financially and trips, whatever it is I want to use, in mostly in investing. That's what it does for me. But can you break this down for us, Jason, into very, very simple terms? What are you really talking about here?
Number one is taking control of your money. Number two is, and I would invite the listeners for just a few seconds to attempt to come up with a figure of all the interest they have paid over their lifetime.
Mm-hmm.
And in the event I could wave a magic wand and put it in an account for them right now, would that be a life-changing amount of money or not?
Absolutely.
Everybody I talk to, that's a very life-changing amount of money. That's the amount of money that they have spent using the
Some,
typical or the banking system that's owned by someone else, right?
right,
When you need money, you take a loan and you pay someone else interest. Or sometimes people say, well, I'm disciplined and then I pay cash. Well, but then you're not gaining interest on that money. So
right.
really, you're learning to get in the business of banking.
Yeah.
The business of banking is buying and selling money as fast as they possibly can. They're buying it from savers and loaning it to borrowers.
Yeah.
Well,
That's what the traditional
that's
savings and loan is. That's what you're becoming. Yeah.
right. And you're putting yourself in the position to be the owner of
Mm-hmm.
that bank. No,
Yeah.
we could do a conventional bank that everybody knows about, but that's probably a 25 year ordeal and probably north of $30 million before you make penny one.
Right.
Right. The other way of doing it is understanding the contract of what a whole life insurance policy can do for you. Has the exact same characteristics, except it doesn't have a checking account.
Yeah. Yeah. Although it can act like it, it doesn't have a debit card, but you can get cash whenever you want it. Yeah.
Correct.
Yeah. And I love it. And I love that. So, okay, I want to break this down just a little bit more. So if you have $10,000 in the bank and you want to buy something for that $10,000, the normal person goes to the bank, takes the 10,000 out. And by the way, what are you earning on interest? You're lucky if you're getting 2-3%, maybe if you have some CD, and if you have it in a CD, you'll pay a penalty to pull it back out, right? If you send it out, if you pull it out before its due date. But so the bank is earning interest on your 10,000. You take the 10,000 out of the bank and you go buy the thing that you're going to buy for 10,000. you are no longer earning interest on that 10,000 because you took it out of the bank. What makes whole life so unique is that you continue to accumulate. It's the eighth law. What did
Eighth wonder of the world. Andrew
the
Carnegie
eighth
said that.
wonder, yeah, Einstein said that, compound interest, right? So instead, you'll go into your whole life policy and take out $10,000 and go do the thing that you're going to do, but still accumulate the cash. It'll still grow with interest because you're not borrowing against yourself, you're borrowing against the insurance pool. And now you pay yourself back some interest on that and manifest even more interest for yourself. So I'm trying to just make it plain and simple. I know there's tons of nuances with that, Jason. I don't want to be an insurance agent. I don't want to be claiming that I know all this, but I'm just trying to make it easy for someone to understand. So instead of putting money in your bank, instead of putting your paycheck in the bank, you put it in your whole life account so it accumulates and you have access to do whatever you want with it at once it's accumulated. So where was I wrong in any of that? And what would you like to
They're
add?
there's some, like you said, a few nuances, but you're pretty dang clear. I mean,
Yeah,
that's very well done.
thanks. Thanks.
I should
Yeah.
hire you more often.
And well, it is, yeah. So yeah, you can pay for testimonials. No, I'm teasing. So, one of the things that people should be thinking about, because this is called business on the vine, and we're learning through the grapevine, right? Is some strategies that can be used for business. So let's talk about some of those strategies that someone listening might be able to utilize for their business.
Number one, if you look at some of the big businesses, let's say General Motors, for example, most people understand that GMAC, which is the financing arm of General Motors, makes
Mhm.
more money for the company than the selling of the cars. It's the financing of the cars. You can go to other types of companies that provide financing for you, and the
Mhm.
financing is more profitable. There's a place here in Utah called RC Willey. It's a furniture company, right? And they have massive stores, all kinds, from the front room to the bedroom to the kitchen, everything in one shop, right? And you can finance pretty easily your purchase of furniture there. And people pay interest to that. And that is a very profitable thing. Well, now think about that with your business. Most businesses have regular expenses. And where are you sourcing the money for those expenses? It may be replacing equipment, it may be inventory, something. When you can put yourself, in other words, start another business, if you will, to finance your business,
Mhm.
that new business eventually will become more profitable than the business that you're in. Most people, I mean, I was just talking to a guy yesterday, a very successful chiropractor, and he says, I'm working my tail off. I work, 80, 90 hours a week doing all this. And the reality is the bank and the financing people are making more on this business than I am. And
Yeah.
I'm unable to work any further. And he was like pulling his hair out. I don't know what to do because I need a new x-ray machine. I need a new ultrasound. I need new this, and lose that. Well, okay, I'm paying 12% interest there and 15% interest there and 9% interest there. And all I
You
do is
have to
work all
work
day
more.
long and they get the money, right?
Yeah, and
They
you
work
have to work
harder and
more.
harder and harder,
Mhm.
right?
Yeah.
Well, it's now let's turn the tide and set up a business to which now you go to that business and that's how you finance the ultrasound. That's how you finance your x-ray machine. So the business, your main business that you're making your money in is still paying that interest. It's still incurring those costs, but those interest is going to an entity that you own and control. And the
Yeah.
cool thing is, Jen, is if you really think about that new business, this banking business, if you will, that you're starting is an exit strategy for the whole thing.
Yeah.
So this
Absolutely.
chiropractor eventually is going to sell his practice, right? He says, look, I'll sell this to you. However, as part of the sale, my finance company gets first right of refusal on any financing needs that this business will need for the next 5 years
5 years. 5 years
or
is so.
whatever long you want to
Yeah.
be. So
Yeah.
now Now
Yeah.
he steps away. He's not, racking, cracking, and stacking them,
Right.
on the
Right.
on the table, but he's financing the X-ray machine or whatever it is,
Yeah.
and collecting that 12% interest
And
for a
he can
young
go to other
chiropractor.
chiropractors in his area and say, hey, if you ever need OPM, other people's money, I'm here for you.
Absolutely.
Yeah. Is this, in this example, is the entity getting the life insurance policy, or is the individual as a designated officer of the company getting the life insurance policy?
So that entity most likely would be a simple LLC or maybe an S corp, depending on how you're structured, and
Mm-hmm.
it sources its funds to lend out from you as an individual that has the policy. Most of
Okay.
the time, you, as an individual, you want to own the policy instead of it being a business asset.
Yeah.
The fact that a business asset could be attached in a lawsuit.
Yeah. Okay. And I figured that. I just wanted to make sure because, you can't take the temperature and get, the cholesterol and the heart rate and everything of a person. And this is why so many banks, when you go to banks, they have so many assistant managers and assistant this is they take out these policies on these people so they can have more of these policies to make more money on the money that you're depositing into the bank. Yeah. And now I've used it. I want to give an example too. I've used it. One of my policies is dedicated to my company so that anytime any funds are withdrawn out of my or borrowed against, there's got to be a better word for this because people are going to think that we're borrowing from ourselves, but we are, but not really. And you got to talk to Jason to understand that. But that it's dedicated to serving my company. So if I want to hire a coach, I tap into that account instead of hiring a coach and putting it on a credit card, instead of making payments to a coach, right? At whatever 20 or 30% markup they have. They always say it's $5,000, if you pay in full, but then X amount of dollars. Well, there's interest in that, even though they're not saying that. And use that for my company so that my company borrows from me and pays me back at a lesser rate than what I would have had on a credit card.
Brilliant. I love
Yeah.
it.
Yeah.
I
But
can give
one
you an
is
example.
dedicated to that. Yeah. One is get
Yeah,
dedicated to that. I've got others that are dedicated to real estate, and that's how I keep it straight instead of co-mingling my loans to myself. I keep them all in that straight line. And that's why I have 7 policies because I need them for a variety of different reasons. But the bottom line here is that, God willing, I live a long time, but if I were to pass away, I have all these policies that will take care of my family. And if there's any loans left outstanding at that time, they are simply reduced from the payout of the value of the life insurance policy, correct?
yes.
Yeah. How are people using this? So that's one way to use it in your business is to, establish sort of a pass-through business aside from your, mowing company, and then you have your mowing finance company. And then yourself as an individual who gets the policy, with your health, and then you pass it through that way. Aside from that, what are some other ways that people are using it, using whole life in their business? Is it to accumulate real estate as a business? I mean, look at Trump Organization. It owns a ton of businesses, and I know they all use whole life. So tell us how you would accumulate real estate through a business if someone wanted to do that. Now, I know you can do it personally, but what would you do in the business side?
Well, a lot of people out there might understand and going from project to project with real estate that they're using the equity in one building and leveraging that to get to the next building.
Mm-hmm.
And sometimes what they'll do is they'll pay down their mortgage or their loan faster to build up that equity so they can go to the next project.
Right.
It's very similar there. Instead of building up the equity inside of buildings, you want to build up the equity inside the real estate. And then you can take loans, as you said properly, against that cash value. And
Mm-hmm.
now you use that as your down payment
Mm-hmm.
or your hard money loan to do the renovation, whatever it is, right? And it's a source of money that can be a lot cheaper than what you're going to get from any hard money lender or bridge lender or even someone that's going to do be willing to take a second position on a property. I mean, you look at someone that wants to take a second position on a property right now, which is you could kind of look at as your down payment. If you're looking to be 100% OPM, right? That down payment is going to be a second position loan from someone else. You're in mid to high teens there. Yet you could access that money from the insurance company, 6% and below.
Yeah.
So just
Yeah.
simply that it would accelerate your ability
Yeah.
to get to more properties and expand your empire, if you will.
Yeah. Well, although it's really funny because, so let's talk about this. So each year the government, and you have to correct me if I'm wrong, each year the government tells us what we're going to be guaranteed to earn in our whole life policy. And it has changed over some years, right? So one policy I have, I'm earning 3% guaranteed. Another policy I'm earning like 3.8% guaranteed, something, I don't know. But so that's the thing I really like about it. When you put that $10,000 into a bank account, it's going to fluctuate with interest rates. When you put $10,000 into your whole life account, it's guaranteed. Period. End of story. It's guaranteed. The lien, the loan that you borrow against that policy is also guaranteed for that policy. Now it could change with a new policy. Am I correct on this or not? I just want to make sure people understand that basic concept.
For the most part, yes. It does vary slightly as far as the loan interest. It can go up and down depending on which company you're with and depending on how you set it up to start off with.
Yeah. Okay.
Right. You can make an election saying, I want it to always be this interest rate, or I'm willing to take, a gamble and say, let it fluctuate.
Okay. Yeah. So you're accumulating, let's just use 3 and 6 as an example. You're accumulating, right? You're gaining interest on your value of your whole life and policy because you're depositing your paycheck in, right? And you're getting all this, you're getting 3% guaranteed. And then you're borrowing money against the policy at 6%. And now when you have this clump of money, where are you going to send it? Are you going to pay off debt at 21%, at credit cards at 21%? Are you going to invest in another property? Are you going to buy equipment? And what would that rate have been? So I look at it as, if I were to take that money out and say, okay, I'm going to pay off some credit card debt at 17, 18%, I'm going to charge my business 9%. So I'm gaining 3 on the money, even when I borrowed against it. I'm gaining 3% on the $10,000. I've borrowed at 6%, and now my company is paying me back at 9%. Now I could go out and just do 6%, but I want to charge my company a little money. Right? Because it's still
I
cheaper than
generally coach
17.
people to say the same, do it the same, whatever the cost of capital for them. And I tell them, go out and get 3, good faith estimates from whoever they're going to borrow money from. Have that in the file in case there's ever a question from the IRS or everything. Say, look, this is what the going
Are you
interest rate was
gouging
at this
yourself?
time.
Yeah.
And I'm charging my company 15%. Fine. In the event the company can do that for an outside source, why not do it to yourself?
Yeah,
Charge that
absolutely.
15%.
Yeah.
And when it's set up correctly, and I'm not a tax accountant, let's be clear, right?
Right.
When it's set up correctly and you have different entities, that interest being paid from your major business to your financing business is a tax deduction to that business,
Yeah.
right? And so you still get
Yeah.
to write that off. You think, well, wait a second, I can pass through some money back into an entity that's income tax advantaged, that I have total control of, that's 100% private. What's wrong with this picture? How much do I want to put there? It starts to be, well, what's the limit that I can put there, not what's the
Right.
minimum.
Right. And there are limits too. And we need to make sure everybody understands that. And that's based on how you set it up in the beginning. So we want to make sure that people understand not a limit to the accumulation. There's a limit to how much you can put into any one policy based on the way you set it up to begin with.
Yet that amount that you want to put in can
Yes.
be, I mean, I have clients that put nearly $500,000 a year into a whole life policy.
Yeah.
And that's a big amount for a lot of people. So, I mean, and yet I have people that do it for their grandchildren that are doing $160 a month.
Yeah.
It's not like a total rich man's game. And it's not, has something to offer for everyone, for the fact that the simple drip of a little bit every month, before long, it turns into a significant amount of money and you could finance something. I have a niece
Yeah.
that started off with $200 a month and it went several years and she kind of forgot about it. And she contacted me
Yeah.
and says, I have that much. Well, then I'm going to finance my Tacoma that way.
Yeah.
She was in this market for buying a new Tacoma.
Borrow
She
from
says,
herself
holy
to get the
smokes.
car.
And it was
Yeah.
a better interest rate than she could get.
Yeah. Yeah, absolutely. I think that that's so important. So I know that a lot of people, and I want to kind of move along now with this because I just need to get that basis down for people to pique the interest of people in what is possible out there. And it's so backwards to our normal thinking that you're probably swimming with your head and going, "Oh, it's not real." It truly is. It's truly real. It's out there. Um, and that is investing in syndications, investing in other things. I know my husband and I have invested in a fix and flip that we got. We invested 25,000 out of our whole life account into a fix and flip at 12.5%. We got 12.5% paid every single month. The loan was for 12 months with a 6-month extension. We got paid back in 8 months. Put the money, all the 25,000 back in, and had all that interest that we had that we kept in a separate account that we were accumulating for us. This is what we did, accumulating for vacation. Now I could have taken some of that money and paid back the loan myself, the interest that was on the loan, but it was accruing at such a low amount. I said, "Oh, let's just save this for our vacation." We've invested in a growth fund, which we're still invested in and receiving 12.5% every month. We've also invested in obviously syndications, apartment buildings and things, but also a mobile home park we invested in. So investing in other things to other real estate, I'll let you decide what it should be, but investing in these other things is also preparing you for retirement. It's preparing you for when you don't need to work anymore, rather than, in the example of the chiropractor, he just decides to close his business and sell everything, on a fire sale, and he has no more income coming in. This is a vehicle to get you to that point. So tell us a little bit about some of the syndications and the other investment opportunities that people tend to use,
Oh
besides buying a
boy.
car and stuff like that.
Buying a car, inventory loans I've seen people do for businesses. I do have a gentleman that has a used car lot. That's how he finances when he purchases a car.
Mm-hmm.
It sits on his lot and it may sit there 30 days, 45 days before he sells it. And that's when he makes money, right? It's in the sell of that. Yet
Yeah.
he used his policy to finance the car. And like you said, the gross amount of his policy is still gaining interest. So the reality is the money is kind of in the car sitting there on the corner,
Yeah.
with the big
Yeah.
sign on the front. But the value of it or the money of it is also inside of his policy compounding.
Yeah.
I've seen renovations, of course, in real estate. I have seen
Mm-hmm.
actual business purchases financed that way. I have a client who was a partner in 7 Taco Bells.
Oh,
Or
wow.
was it
Yeah.
10? I don't remember. I think it was 10. And we were into it a little ways. And the loan on their Taco Bells was like 10%. And I said, well,
Yeah.
do you think your partners would be okay with you doing it at 9.5% and extending the term? I think it was a 10-year term. And it says,
To
let's do a
15.
20-year term.
Yeah.
So now
Yeah.
all of a sudden, the nut every month that Taco Bell needed to be paying was a lot less. Well, he had the money to do it.
Yeah.
So we refinanced those every single Taco Bell for his partners, and now he was making nine
Oh,
and a
what a
half
great plan. Yeah.
percent, right?
Yeah. I know.
Where
I have a friend who owns a franchise. I think I'm going to call her. Right.
well, yeah, finance it for it because
Yeah. Yeah.
there's always an underlying asset, right? When
Yeah.
you're doing that, you want to be smart and do that. I have
Yeah.
also seen someone finance for someone else an operatory for a dentist. I mean, those
Yeah.
chairs are $50,000 to $70,000, and they're paying
Yeah.
12 to 15% interest. So that's it.
Wow.
Nelson Ganache, the guy that wrote the book I talked about earlier, he used to golf all the time with some attorneys. I mean, and they have a very high end firm. And
Yeah.
he'd tell them, hey, you guys publish this book. Read my book. We read my book, read my book. And he tells the story. He said it went several years and they wouldn't read it. And they're out golfing and they're getting a new Gulfstream, a new plane that they fly their attorneys to different clients, moaning and complaining. Oh, yeah, look, the best we can get is 15% interest and this and that way. Blah, blah, blah. And he's just sitting there listening. He goes, guys, I know a place that you can get 14%. You can get the same amount of money. You can refinance and get your new plane and then get it 14%. And they said, seriously? He says, yeah, I know I can put it together for you. Well, he ended up
Of
financing
doing
that
it, of course.
plane purchase himself,
Oh,
right?
yeah.
He'd always lean into it. He goes, I hope they never read my book.
Right.
They'll never, ever read my book now because
Yeah.
they'll know
Yeah.
exactly what he's doing, that he's the one that's capturing that 14%.
Yeah. Yeah. Yeah.
And
And I
that's
love
really
it.
good.
And
I
yeah,
mean,
go
that's,
ahead. No, go ahead.
that very easily later in life.
Yeah.
You can, your mind's still good and you can push the paper around and have people sign things, right? And that's something that people's need for financing is not going to run out.
Yeah. Yeah. That's correct. That's correct. And if you can help people, it's great. And I know, people obviously use whole life for college education, for graduation. Yes. For children, putting the grandkids and stuff, because you can insure them, putting them, the grandkids on the policies. They're the beneficiaries of all the policies, and growing that for their wedding, and growing that for their first home, and growing it for all kinds of reasons. And I think that is really powerful as well, for those that understand it when they're young. And my daughter just took out a policy as soon as her son was 6 months old. Policy. Doing small little payments, but she's accumulating and never to touch it until he gets to the point where maybe they buy a car. Maybe it's for college. I don't know. And you don't need the 401, whatever. What's the 5? What's the college plan?
529.
529, because you're making the money on it instead of your broker making the money on it. And I love that. Okay, so last but not least is, let's talk a little bit about 401ks as we end our time together today. With 401ks, I'm sure you've got some thoughts about myths and ways and IRAs and Roth IRAs and Roth 401ks. So tell us all about 401ks and what your perspective is on that.
For anything 400 series, which is like, that's a section of the IRS code 400. That's where 401ks come from. The IRAs there, the Roth IRAs are all part of there. The 403bs, which is often like in with public servants and things like that.
Right.
That's all government sponsored, and that's all run, if you will, or controlled by Congress. And that point right there was what makes me shy away from it. You might get a tax deduction today and say, okay, well, I contributed 5,000 to my IRA, so I have $5,000 less in income, so I'm going to pay less interest or less taxes. Yet you
Right.
don't know what the taxes are going to be in 15, 20 years when you retire or you go to, or you need to access it. So I shy away from it for the fact that Congress can always change their mind.
Mm-hmm.
From the very beginning, the Roth, which Senator Roth, what he was attempting to do was mimic a whole life insurance policy, believe it or not. And later in life, after that had passed and has gone on for ways, he wished he wouldn't have done what he did. He wished he
Mm-hmm.
wouldn't have gone to the Senate and said, let's do this. It just did not turn out the way he had envisioned it.
Right.
Having said that, though, for a long time, you put in after tax money, but all the growth was tax free until 59 and a half.
Mm-hmm.
Well, there's people now in the United States that have Roth IRAs that are in the billions for the fact
Yeah.
that they started a tech company or software company or something, and they put all of their stock ownership inside their Roth, and it exploded. Well, that has caught the attention of Congress. And even this last Congress, they talked about, do we change the rule and start
Unrealized,
to tax it? Yeah,
unrealized gain.
unrealized gains, all
Yeah.
kinds of crazy stuff. And it's
Mm-hmm.
like when you have those accounts, you're in bed with, or you're in partnership with the government on that account.
Yeah. Yeah. And
And
it's 70 and a
I don't
half.
like that.
And it's
it doesn't feel comfortable to me.
right. And at 70 and a half, you have to take distributions. You don't have a choice. You have to take them. So where are you going to put them? What are you going to do? What if you, think that you're going to live for X amount of years, or at 70 and a half, nobody's retiring that early these days. And if they are, they're going into a second career. Right. And so that was an issue for me. I didn't want to be forced. There's always penalties for early withdrawals. Sometimes you can get the penalties. Well, you definitely can get the early withdrawal penalty waived at 59 and a half, but you still have to pay taxes on what you take out. And at 70 and a half, all of a sudden you have to take the distributions and you're taxed on whatever your income is at that time. But the more you take of distributions and plop it in a bank account, the more interest you're making, the higher your income, the more you're taxed. I mean, it's a very vicious circle. And I see what you're saying. I mean, I yanked out of every 401k I ever had, every Roth I ever had. I paid all the penalties just to move everything into my whole life because it just is more comfortable there. And I have control over it. I don't have to call somebody and have them talk me out of it or talk me into it or any of that. I don't have to fill out 100,000 forms. When I want my money, I fill out one form and I get my money. And I love that. Absolutely love that. Any parting thoughts you'd like to share with us? I know I've talked a lot. Normally I don't talk this much on an interview, but I just have stories to tell and things to talk about. But any
I
parting
love it.
thoughts?
So love of what you've said. I mean, I will tell you one quick story. This goes back about 17, 18 years ago. I had an individual I started to work with, and we'd been family friends. His dad and my dad had been friends a long time, and finally got some time with him, and I met with him and his wife. I said, really, what? And I looked at her and I said, what is it that you would really like to see happen? And she started a little while and she burst into tears. She goes, we have 5 sons and he works all the time. I
Mm-hmm.
just want him to spend more time with the boys. They're growing so fast and they're going to be gone. And I looked at him and I said, that starts now that you start spending more times with kids, or I'm not working with you. Now, it's been just a few months ago, he invited me up to the memory maker. It's a cabin on
Okay.
700 acres.
Wow. Yeah.
It is unbelievable. And the view from there it's unbelievable.
Breathtaking.
And it's all about it. I helped him to understand that, yeah, he was working incredibly hard, yet instead of having to come in and going out and financing everything from all these different people, and it was business expenses, right? He
Yeah.
writes off everything. He's very good at doing what he does that way. Yet he started to recognize, well, if I put it through the whole life policy, it's going to start accumulating interest. Even though I'm using it in my business, that compounding starts to get more and more and more until he's starting to feel like, hey, I have room to take Friday off. Hey,
Yeah.
I have room to do this. Hey, I have room to have this cabin. And he just invited me up there, and kind of, and he said just the other day, he says, he saw something on the internet. He texted it to me. He says, I'm not spending money. I'm buying memories.
Yeah.
I
I
was
love
just,
that.
there's, no commission, no anything that was as valuable to me as that right there. And
Oh,
that's what's
yeah.
really, I
No
love
doubt.
about it.
Because, yeah, and he probably bought that cabin using his whole life,
He
or
did.
another one that he had. Yeah. So the key here is, one, to learn about infinite banking. That's number one. Number two is to get in touch with Jason, read his book, Master Your Millions, and then get in touch with Jason and explore this a little bit more. But the thing is, hurry, because you're not getting any younger. Right. And I'm worried at some point for myself, I'm like, okay, I just turned 61. So I've crossed over another threshold, of, oh, these life insurance policies are going to cost me more and more and more. Right. So get them done now. Get it for your family, get it for your spouse, get it for your children. Do all of that work now and watch what happens. Because just like your daughter, was it your daughter, your niece told you, I forgot about this money here. I was just making a premium payment and I didn't realize what the cash value was in the account. And I was like, well, what am I going to do with that now? Because I haven't paid attention. And I think there's a good piece of that. I think it's good that we don't watch it every day. I think it's good that, maybe once a quarter or once every 6 months, we're going in and creating a new roadmap for ourselves. But I actually haven't looked at this policy since COVID, because I drew out of this policy during COVID because I couldn't get a PPE or a PPP loan. So I drew out of this account for COVID on behalf of Kinetic Spark Consulting, my company. And I'm slowly paying it back and this, that, and the other. But in the meantime, it's still accumulating. So now I'm going, now what can we do with that money, right? I hadn't looked at it for 4 years. So, there'll be movement happening. And I think it's important. I learned this from, well, I'm sure everybody does it, but Grant Cardone has this one saying, and he just says, keep your money in flow. Never let it sit, keep it in flow. And that's what we're doing through these whole life policies is we're keeping our money in flow and finding ways that we can do other wonderful things with it to create wealth, and sustain a business these days, right? It's a key thing too. Any quote that you have for us?
Oh, that's awesome what you say about getting in touch with me. I'm sure we'll put it in the show notes, but askjasonh.com is a great place to go to find a free report and a link to link up with me, make schedule appointment or something and go forward.
Yeah, that sounds great. We will put all that in there. And thank you again, Jason, for coming here. I love what you're doing. I love what you're doing. I'm an advocate for you. And I just, I hope that someone listening, the light bulbs just went, not one, but multiple light bulbs went off and said, what am I doing? I've got to explore these other options that are available in the marketplace that billionaires are using. All of our presidents use it. Every president that is alive has these policies, and that's how they do everything. Warren Buffett does this. So if you want to be playing with the big boys, even with a little bit of money, this is the place to do it. So thank you, Jason, so much for being here.
Thank you.
I sure appreciate it. All right. And thank you for being here. We'll catch you on the next episode. Thank you for joining us on Business on the Vine. If you found value in today's conversation and would like additional support, go to supportfromjen.com. Remember, the best ideas are always discovered on the vine. So keep innovating, stay inspired, and continue to grow.